In our last recording of the year, we were delighted to be joined by Simon Edelsten, the Chief Investment Officer at Goshawk Asset Management and the Fund Manager on the boutique's global equity strategy. I'm sure many listeners will be regular readers of Simon's topical column in the FT and will know him from his days at Artemis Investment Management. As we approach the end of the year and make that natural step to start thinking about what might lie in store for markets in 2026 and beyond, this is a great time to catch up with Simon and talk through some of the major issues facing investors at the current time and where this experienced money manager is currently finding opportunities for his global equity mandate. Welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik Co YouTube channel, or by searching for Killik Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killik.com. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details on the unique ways in which we do that at our website killik.com. In this week's episode, we were joined by Simon Edelsten, the highly experienced fund manager and CIO at Goshawk Asset Management. Simon started his career as a stockbroker in the 80s and 90s, and then in 2001 joined Tobe Hodson StoneX, becoming a partner and part of the senior team responsible for several global equity mandates there. 10 years later, Simon, alongside colleague Alex Illingworth, joined Artemis and launched the Global Select Fund, and also took on the mandate to run the London-listed Midwind Investment Trust. Simon actually retired from Artemis in 2023, ending a very successful tenure there, but came out of retirement last year to join back up with Alex Illingworth at Goshawk, and we discussed the company's flagship global equity mandate in our discussion. It's always useful to get Simon's well-considered view on the current backdrop. This is our last episode of 2025, and so we'd like to wish all listeners a very happy Christmas and best wishes for the coming year. We hope you've enjoyed the discussions over the last 12 months. We tried to keep the topics of conversation both varied and topical and cover a range of geographies and specialist investment areas. We'd love to hear from you if you think that we've neglected any areas, or if you have any suggestions for topics that you'd like us to focus on and find guests for as we look to book in new speakers for the coming year. Please use the investorinsights@killik.com email address to get in touch. Simon, good morning. Thank you so much for sparing some time for this. How are you doing today?
Very well, thank you very much. Thank you very much for asking me, Gordon, and I look forward to having a chat.
Yeah, no, as do I. So we've got this kind of regular first question that we ask, and I think we've asked everyone on the series this question. All it really aims to do is kind of get a bit of an insight into you and kind of how you go about your work, really. So we've been asking for people to perhaps share an anecdote from a recent trip or meeting that they've had, or research project that they're doing, or even just an article or book that they've read. We've had some book recommendations in this bit. Is there anything that you could share for us?
Absolutely. Funnily enough, books are absolutely central to how we go about running the funds, and I think the fact that we stand back from a lot of the city chat, a lot of the city comment, a lot of the analysts comment, helps us get perspective. The thing about running a global equity fund, which is a bit different from other funds, is that the canvas you're working on is so broad. You've got every stock and every market in the world, every sector in the world that you could make money in or lose money in. So you need to be find a way to get yourself quite focused in on stuff that you think is particularly advantageous, subjects you think particularly worth spending time on, and areas where you think you've got a competitive advantage. I mean, you're buying these shares off other people. You've got to believe, even though you're a small team based in London, you've got to believe that you know more about it, or you've got a better sense of what a stock's worth than all these hundreds of thousands of other people around the world looking at the same stocks. One of the ways in which we try to do that is, well, one of our few advantages in life, the team at Goshawk, is that we're very old. We've been around for an enormously long time. So I started in the mid 1980s in the city, and so did two of my other colleagues. We're a team of 6 people. So we've probably got the oldest average age of people in the city. And while that has some disadvantages, it in fund management it does have the advantage you've seen a lot of cycles before. And I think we're quite clued in from that point of view in how the market gets overexcited about things from time to time, but also how it gets excessively depressed about things. And the good thing, to go back to reading books, the good thing about reading books about sectors and industries is that they tend to give you a better sense of the historic perspective. And that's true even of the most hip, modern sectors out there. So one of the best books I'd read recently, a book called Supremacy by Parmy Olson. I had no idea. It turns out that this is the FT book of the year for last year, but I don't seem to have met many other people who've read it. Anyhow, it tells the story. It's very readable. It's all about AI, which is, of course, fad of the year, certainly topic of the moment. But it actually tells the whole of the history of the starting up of this, including the massive role that DeepMind business set up by Dennis Habibi in London, which is based in King's Cross and was bought by Google. How they actually, the Brits are actually at the cutting edge of this right at the beginning, and the Americans actually doing some catching up. I mean, rather extraordinarily, when you listen to politicians or whatever, and they say, "Oh dear, the UK doesn't seem to be up to speed with any of this," is complete rubbish. I mean, one of the main centers of AI and one of the leading and best products in AI is developed in King's Cross in North London, and still is. The shocking thing about the story, in a way, is that when they were looking for more finance to try to commercialize this, not a single British business turned up to offer to buy them. So they ended up being bought by Google. And so we, as global equity managers in London, people ask us, why can't you invest more in the UK? Well, we do invest in the UK. It's just sometimes it's a subsidiary of an American business, in this case, Alphabet, which owns Google, which bought DeepMind. But it is a British business, and actually British scientists, including British neuroscientists, as well as computer programmers, who have made this the success it is. So hopefully that gives you a picture here that even when you're dealing with something very modern like AI, and which seems all about, well, is a very speculative area and seems to have too little history to base your investment judgment on, we don't tend to find that's right. The more you know about the history of any of these sectors and why people ended up in one company rather than another, who owns what, who started where, you not only get a advantage over the market and people who don't look at that, you have to do the valuation and everything as well. But I think it gives you a better framework for understanding what's going on. Perhaps a different picture from just reading the news headlines about why X is in bed with Y and the rival is Z, and who's likely to win and who's likely to lose. And so I hope that gives you a picture of how we go about things and why it's a bit different from other people.
Yeah, no, it really does. Yeah, thank you. I totally agree. It's very, very easy to get caught up in actually the short term as well, and taking a step back and looking at the long term, is the kind of wider picture through reading is so important. Yeah, great to get another book recommendation. So thank you for that. There's also lots to pick up on there, and I think we'll come and talk about a lot of those the kind of points that you briefly mentioned there. But you mentioned your long career. I imagine actually many of our listeners on the series will know you from your time at Artemis and or managing the Midwines Trust as well. I wondered, obviously, the decision to come out of retirement and join Goshawk. I wondered if you could kind of give us a brief summary of the approach that you're taking there and the reasons for joining Goshawk.
Yeah, so Goshawk was set up by my close colleague Alex Illingworth, who'd left Artemis around the same time I left Artemis. Artemis was going through a period of change, and For various reasons, Alex ended up being invited by a very successful city chap called Christopher Mills, who runs a range of investment trusts, who's even older than me and has been at it for longer than me. Christopher was behind setting up Geo Hambro Capital Management and also helped Poda Capital get set up. So although he's I was calling him more a small cap entrepreneur than just an investor, but he also likes building businesses and he likes backing people who want to set up a global equity fund. And so, Alex reached this agreement, got the backing from Christopher, Harwood Capital, and they've set up a most splendid platform for Alex and I to get back into business and try to recreate basically what we did when we came together in 2010 at Artemis, where we launched the Artemis Global Select Fund, which had a pretty good track record over the period, over a dozen years we worked together there, and the Midwind Investment Trust. So a number of people in the investment trust community remember us running that fund in happier times for the investment trust sector, I have to say. But all the same, it traded at a premium and more than doubled its shares in issue, which is rather the opposite of what's happening in the sector at the moment. Our style and our niche, if you like, is we're not interested in the index at all. Our funds will never be anything like the index. Sometimes that's a very good thing. Sometimes the index will do a lot better than our funds. Sometimes our funds would do a lot better than the index. It's just not, we don't think it's a sensible benchmark. What we're trying to do is to, as you would imagine, grow wealth over time ahead of inflation through investing in equities around the world. And the way in which we think is sensible to approach that is to look at valuation and to try to have a good balance between companies that are growing fast and companies that will protect your capital in more difficult times. And it's rebalancing the fund between those two areas that has given our funds a very distinctive mix. Quite often, although we have had and we carry on having quite a lot of money in AI, despite the fact that people keep calling it a bubble. It's certainly speculative. I don't think it's necessarily a bubble. If I can still find stocks which are on reasonable valuations, I'll own them, and we still do around the world in that space. But however much money you have in technology in the sort of excited parts of the market, you want to balance that off by having money in parts of the global equity market that everyone's totally ignoring and that are on and that are very heavily backed by some sort of intrinsic value. And that way, our funds quite often will underperform a rapidly rising market, but we make up for it by the funds generally protecting I have to say generally protecting capital much better than the average when markets have big corrections. So whether it was the pandemic or the Ukraine war, these sharp corrections, our funds have tended to hold their capital value reasonably well. And other funds I ran back in the 2000s were particularly well known for that. In more choppy times, we haven't actually had very choppy markets and over the last 15 years. But I think one of the easier predictions to make today is that we're likely to have more periods of turbulence in the years to come because valuations have got high. So how do we try to build a more balanced portfolio? One, have a broad mix of different investments, but two, always be disciplined on valuation. And so at the moment, there's a lot of pressure on people just to say, well, I know that the AI stocks are expensive, but it's very exciting. And, I might get fired if I sell all of them. I mean, that isn't the sort of thinking that bothers us. If we think a stock's expensive, we sell it, often famously much too early. But we prefer to sell things early than find ourselves holding those sorts of stocks when markets reverse, because you just don't have time to. The market is much too swift in correcting for you to suddenly say, oh, goodness, I should have sold all this stuff last week. When it goes down very, very fast. So we're always trying to position the fund so that they've got some capital protection built in. That's the plan.
Yeah, absolutely. Yeah. I wondered if I could pick up and ask you to talk a bit more. You've mentioned actually in the first two questions about the market getting over optimistic at times and then overly pessimistic and kind of managing kind of through that cycle, and the AI bubble talk. I mean, you've got a very well-read FT column, which I know has picked up on this point quite recently. But there is kind of growing concerns, I guess, around whether it's just valuations, the level of capex being spent, and even this kind of circular financing deals within the tech sector. I just wonder, could I ask you to go into a bit more detail about kind of how you've navigated that, kind of how you're approaching that area at the moment?
Yeah, absolutely. So I think that there are two separate points here. The first one, I think we're in quite a speculative phase in finance, but I actually don't think the worst of the excesses are actually in AI. I think the worst of the excesses have been in things like Bitcoin, which shot up and then collapsed. So that tells you that there's hot money going around, which you're looking for a home, if you like. On the other side of the equation, the bond market is actually telling you to be more cautious. Japanese government bonds, which is, one of the massive markets in the world. I mean, their yields have done nothing but go up for the last 3 years, and Japanese government bonds are now yielding more than European government bonds, which I never thought I'd see in my lifetime. So there's some weird things going on behind the scenes. So you should always worry, even though we're equity investors, because we're capital protected, we spend a reasonable amount of our time being paranoid and worrying about speculation. Speculation is fed by cheap money. Cheap money was fed by being able to borrow cheaply in Japan often. I mean, that's the really big trade, so-called carry trade. And that's now being turned off. I mean, it's just not, it's not cheap to borrow in Japan. And the yen may not carry on going down as it has done conveniently for people who borrowed in Japan for the last few years. So next year is likely to be tougher for this speculative money aspect. Now, where's the speculative money gone? The funny thing about the AI stocks is that, with one or two exceptions, they're incredibly cash generative businesses which don't have any debt. I mean, Apple, for instance, has massive cash piles. Amazon has massive cash piles. Some of the people building the data centers, Oracle in particular, are now getting themselves into debt because building the data centers is costing hundreds of millions of dollars, billions, sorry, of dollars, as you would have seen in the papers. And so the other week, Oracle launched some of its own bonds, and the bond market said, "Oh, blimey, we weren't expecting any bonds to come out of the tech sector." And then they ended up saying, well, actually, Oracle's got quite a lot of cash flow. It can probably afford it. Where the bond market gets worried about debt is actually in private equity, particularly in America. And so, oddly enough, even when you get worried about the world, you probably worry about shadow banking, private equity, that sort of stuff, and not actually public equity, large cap, Mag 7 and the bubble there. The papers go on about it because the public can choose whether they invest in those stocks or not, but they're not sensitive to the biggest risk out there. So where are there speculative bubbles? There definitely are speculative bubbles. I mean, that's not to say that some of the AI stocks don't look to me to be wildly expensive. I cannot for myself work out. I mean, I can't get anywhere near to the valuation that a company like Palantir's on, which it's a lesser known company, but I can tell you it's a massive American company on a P of whatever, a billion or a trillion or something else. I mean, it's gone from nowhere. It's one of Trump's favorite stocks, as you would imagine. But anyway, and Tesla as well is a stock I find very impossible to value. When you get into the Mag 7, though, I mean, Nvidia, it's on 30 times earnings. I actually think that's very expensive, but I don't think it's bubble territory like we had in 2000. It's just expensive. And then when you drop down below that, I mean, one of our favorite companies for AI, AI's gone through the phase where you train the chips, and now we're getting into the phase where you actually got to persuade people to do some of this stuff and pay for it. When you get into the commercialization phase, what do you need? You need a sales team. And so OpenAI has teamed up in recent weeks, and a couple of the other AI development companies. They've teamed up with Accenture, which people know as the world's biggest IT consultancy company. And you can imagine, if you're a big firm and you're thinking about putting AI into your system, Accenture is going to be one of the first companies you're going to ring up and say, one, have you got a working thing that we can actually put in? 2, will you come back and mend it if it doesn't work? And yet, amazingly, Accenture shares have done nothing but go down for the last year. I should know because we have quite a lot of them. And they now trade on 22 times earnings, which is a very straightforward multiple for, if that company was trading, if Accenture was quoted in the UK rather than America, I suspect it would trade on a higher rating than that. But they've been seen as an AI loser. And in our view, they're an AI winner. It's just they're for the second phase. They're for the commercialization phase, not the chip setting phase. So in each of these themes, I still think you can find stocks out there. And on top of that, we've been buying robot companies in Japan, which, of course, being in Japan, are on a fraction of the rating of anything in America because the Japanese equity market is generally that way. And again, even Jason Huang of NVIDIA says the future of NVIDIA is in robots. So we think, oh, shall we buy some NVIDIA or shall we buy the robot stuff he has to buy from Japan because they don't make it in America? Company there called Keyence, again, has performed very poorly. It's the world leader in making sensors for anything in robotics. You want a clever robot, it's going to be full of sensors. They're going to have to pay a lot of money to Keyence for the sensors to make the robots work. And also the kit that makes robot arms move gently and carefully to pick up a boiled egg, all that stuff. It's all made in Japan. There's absolutely none of it made in America at all, much to Donald Trump's displeasure. But they're not going to catch up because the Japanese have been doing this for 50 years. So again, you follow the theme through, you write down the stocks which might be in the next wave, you check the valuations, and you end up with a portfolio which actually is exposed to the themes out there, but is much more geographically spread and on much lower valuations than the hot stocks. I mean, that's what we do. It sounds straightforward, I know.
No, very sensible there. Yeah, no, thank you for running through that. Let's maybe move away from the tech sector slightly. I mean, I know a lot of your commentary is very clear that kind of exercise that you've just explained, really, kind of recycling of capital from more richly valued areas, reinvesting into better value elsewhere. Could I ask you to maybe highlight there are other areas of US, European markets, but also I know Japan is a kind of notable area for you as well. You touched on some areas of the Japanese market, but where are you finding kind of compelling value at the moment outside of tech?
So one of the most, I mentioned earlier that Japanese government bond yields going up, Asian bond yields going up at the same time as American Fed fund rates are being cut under pressure again from the president. Rising bond yields generally are quite good for banks. So we own banks in Asia, and actually Asian banks have doubled last year and they're still cheap. I mean, British banks have even doubled last year, best performing stocks in the UK, whereas American banks were quite expensive anyway and have done nothing. In fact, JP Morgan's gone down recently on its figures because they're quite expensive. So again, in Asia, you can find stocks which balance out a portfolio. I'm not going to pretend that a Japanese bank is a long-term growth stock. It isn't, but it serves a purpose in a portfolio so that if people get worried about bond yields or if people get worried about inflation going up, our funds have that built-in balance so that when the tech stocks have their bad days and they all go down together, we got some Japanese banks and things which will go up on days like that, and that gives it some balance. The second side of the world, which has actually proved the most difficult, is trying to find defensive stocks. And a lot of people who run funds in our area that compete with us have suffered quite a lot from buying things which they call quality growth. And I think this needs some explaining. In fact, I remember 25 years ago, somebody said that I came up with this term, quality growth. And what people mean by it often is branded good companies which have a natural ability because of their brands to put up prices during periods of inflation. And these companies haven't really changed in 25 years, but they have performed really badly. Share prices have performed really badly the last 3 years. And for us, there are very simple reasons for that. They tick all the boxes in terms of, is this a good quality company? Yeah, we like that. Can these companies survive periods of inflation? Yeah. And then third one, are they reasonable valuations? And for us, for the last 3 years, the answer has been absolutely not. they all went up during the pandemic because people wanted safe stocks to hide in. This is companies like Nestle, Diageo in the UK. But by and large, they've not, the ratings ended up much too high for the underlying cash flow, according to our valuation model. They've then gone down a long way in a bull market over the last 3 years. We are now just starting to see a little bit of value here. We have actually just bought some Nestle. I think I mentioned that in an article in the FT a couple of months ago. But we've only started to buy these things. We've still got much fewer holdings here than most other companies, most other fund managers of our style. We're finding better value in American healthcare companies. Again, even right-wing American politics tries to get the cost of healthcare down because, it's an election issue. We've got a midterm elections coming up next year. But the valuations here have really been hammered over the last couple of years. And the demand obviously never goes away. So you get these phases where the politicians try to squeeze the healthcare companies, and then the reality of the massive rise in demand pushes back the other way. So we think there's quite good value for money there. It's much harder to pick stocks there. The American healthcare system is quite a complex thing to get your head around. But it's notable recently, just the last few months, the healthcare stocks have started rebounding really quite well. You have to pay a little bit more for them. We've been adding to Johnson & Johnson, one of our biggest holdings there. That's on about 20-21 times earnings. So again, you can buy quality growth companies. I'd prefer to buy Johnson & Johnson than a drinks company, for instance, because demand for their products going up, and the drinks companies, unfortunately, the youth of today doesn't seem to drink. So the worry is that the demand for their product is going down. So you still need to have a bit of a updraft, a bit of a following wind, but the valuation is always key, and that's often been why our portfolio shape has ended up perhaps surprising people when they look at it. Why don't they have more money in this area? Other people do. Well, it's about being valuation disciplined in the end.
Yeah, absolutely. Yeah, really interesting to hear you talk through that. And yeah, thank you for that. So we're recording this obviously middle of December, and we're getting a lot of the kind of investment bank and year ahead outlooks. You often, it's kind of that time of year, I guess, that you get that, and it's often a time when investors start to look at kind of what's coming up in the next year. I wondered if there was anything kind of noteworthy that you're looking at, and kind of watchful of or adjusting positioning for 2026. I know you've kind of obviously got a long-term outlook, but there is some things that are happening, changing guard at the Fed, for example.
Yeah.
And I've heard in your recent commentary talking about the US consumer and inflation and that sort of thing. Is there anything that you point to for 2026 that you're kind of looking out for?
Yeah, so in the short term, I'm worried about inflation. I think it's stickier in the UK and America than the bond market seems to expect.
Yeah.
And I'm worried about the Japanese bond yields being high, but I'm not very worried. And actually, all the companies that we own around the world have had a pretty good 2025. They're in pretty good shape for 26. They've coped with tariffs. They've coped with higher bond yields. There's starting to be a bit of M&A around with the Time Warner deal recently and some biotech deals. So there's quite a lot of confidence out there. So the business sector is much happier about life than the public. And in our portfolio, you can finesse that. So we don't have that much money exposed to the consumer at the moment. And we've got, particularly not in America, and we've got quite a lot of money exposed to industrial investment, which is unusual, but does seem to be coming through, including some stocks which will do well if China slowly starts to get itself out of deflation next year. But the main message that I would have at the moment is I can't believe how many people think the market's going to crash. I think there are a lot of pundits who just say, "Oh, it's a bubble; it's all going to blow up." And I meet a lot of people who've sold all their equities and headed home. And I just think there's no need to do that. There are plenty of stocks around the world which are on sensible valuations, um, and which are in very healthy conditions, which have strong balance sheets and strong businesses. And furthermore, we are actually going through a very exciting period of technology change. I mean, it's not just AI. Is computer power in general going into medical diagnostics, or into streaming, or into a range of other, new waves of biotech as well, new waves in healthcare. So this is an exciting period to be invested in businesses. I think choose really good quality businesses, pay a little bit more than you'd like to for them, and leave them alone to manage their companies properly. But I don't think the valuation, the time when I think that we're at the top of a bubble. Firstly, in my experience, most people are saying buy, not sell, 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 run for the hills. I'm afraid people say sell, sell, sell in the middle of a bull market, not at the end of it. I'm sorry to be cynical about it, but that's my experience. And then the second thing is all the valuations are very, very high. I mean, in 2000, the valuations were ridiculous. They are not ridiculous today. There are a few expensive stocks out there, very high profile ones, big parts of the index. So if I owned a global index fund, I'd probably be a bit nervous. But if you're in a stock picking fund like the Goshawk one, we try to avoid the worst of that. And we're looking forward to next year. I think it's going to be another good year for equity investors.
Yeah, absolutely. Yeah, no, thank you for that. So it's taking a sensible approach and riding through some of the exaggerated valuations. Yeah, that's come through well in this conversation. So we've got a tiny bit of time here at the end. We've got a standard closing question just to bring things to a finish. And it asks the speaker to highlight there was kind of one area of their investment universe that they are particularly high conviction at the moment. I appreciate you've mentioned a fair few already as we've kind of gone through, but is there one area that perhaps we haven't talked about, one area that you'd highlight that you're particularly optimistic on at the moment?
I still think Japan is a bit of a hidden secret.
Yeah.
It's not as cheap as it was. Japanese shares 10 years ago, a lot of shares traded on half book, which was so deep value investors. At one point, I worked at Phillips and Drew. They have a deep value fund management business, which rather informed me when I was very, very young. And you could buy really deep value stocks in Japan 10 years ago. Now that value has gone away. But the remarkable thing about Japan and South Korea as well, in an interesting way, is even more than Europe, they now worry that America is unreliable as an ally, and they've got China on their doorstep. And you just get this feeling they've said, right, stuff it. We're going to look after ourselves. And there's a really substantial change across the board. There's a substantial change in getting up and getting on with running successful businesses, looking after their own country. And you don't want to be in the activist funds anymore in Japan. You just want to be in the mainstream the big Japanese companies, because when they pull their fingers out and make an effort, they're a remarkable set of businessmen with a remarkable set of businesses, still world leaders in lots of areas. And the value for money you get as an equity investor is just exceptional. We've got one stock in Japan, Topan Printing, which still trades at book value, and it put out a press release yesterday saying, "Oh, by the way, for the next wave of AI, we have 98% market share in one of the most obscure things, flip ball arrays." Oh, good. All right, fine. I've had to learn about that. But, Japan just does this stuff nobody else does, and every now and again the world needs it, and the stocks involved are very, very cheap. So yeah. Don't miss out a bit of Japan. And I also think, by the way, sorry, I think it's very unwise for pensioners, long-term savers, not to have any exposure to China. You may have enormous problems with it, communist country and all that, and not always following the rules. But it's a big economy, and it should be part of one's savings, however you go about doing it. We have about 6% in Japan, but in businesses, we know Beijing is happy to support. But I think it's as important that people have some of their savings in Japan as in America, frankly.
Yeah, absolutely. No, yeah, concur with all of that. Yeah, thank you for that. Simon, as I said before, thank you so much for spending some time for this. Really interesting to talk through things with you. Thanks for your time.
Thank you very much, Good.
Thank you for listening to the Investor Insights podcast, hosted by Killik Co. You can get in contact using our podcast email address, investorinsights@killik.com. For more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.